Joining us now to help break down what we can expect from the economy, AI, and more, Sequoia Capital Managing Partner Roelof Botha. It's good to have you back. Welcome.
Good morning. Thanks for having me.
We're seeing this huge sigh of relief across all markets this morning with the 10-year note yield falling below 4.5%. How much is that going to do you think, to your world, which has also been hit pretty hard by high rates?
Interest rates don't have a huge bearing on our business, to be completely candid. If you go back in history, our original investment in Apple in the 70s, Cisco in the 80s, NVIDIA, Google, PayPal in the 90s were all in interest rate environments higher than what we have today. So founders aren't really that affected by interest rates when they start companies. The biggest impact has been on valuations.
Right. So what happens? Do you see, first of all, how bad have valuations gotten, and what happens next?
Valuations have come down dramatically, as I'm sure we all know. If you disaggregate the change in valuations for companies over the last 12 months, about 85% of that is attributable to the change in interest rates, but only about 15% from companies' forecasts changing. So as interest rates come down, I think valuations will normalize.
So how has it affected Sequoia? Are you marking down a lot of the investments?
Well, all the public stocks we've held obviously are marked to market almost immediately, and we have valuation guidelines. Well, the private companies have to be valued by independent auditors, and they use public comparables. So to the extent that public company valuations trade down, those affect our private marks as well.
I guess I'm just wondering how dramatic it's been, the markdowns across the space, not just for Sequoia.
I think the markdowns have been significant. I don't know if all venture firms follow the same rigorous approach we do in their valuation marks, honestly. And so my guess is there's a lot of so-called dead FMV sitting on venture firms' books where they haven't actually taken the medicine and marked down their portfolios.
I guess the question would be, if we really are turning a corner on the cost of money, if valuations are bottoming, and whether or not you think things that have gotten cheap are about as cheap as they're going to get.
That's very hard for me to predict, honestly. Our focus is really on working with founders to build companies for long-term value. And, we're involved with companies for so long. We take a decades-long view when we partner with companies, and we can't trade in and out of stocks. And so we're really just focused on long-term value creation in these companies.
Will it reflect a turn in deal volume or deal count?
That really depends on founders coming up with great ideas, honestly. The deal count was down pretty dramatically in the middle of 2022. I think the whole world was in a little bit of a shock, and there was stasis. But this year, activity has picked up dramatically. The number of seed investments we've made has more than doubled over the previous year. We're seeing tremendous activity in and around AI, an area that is so exciting and brims with promise.
Yeah, where are we in that cycle, and how has it bucked sort of the broader trend around valuations?
Well, I'd say the first layer that you've seen in AI is what I'd call the sort of foundational infrastructure layer. And you can almost liken that to what the cloud infrastructure companies provided, what you got from AWS, GCP, and Azure, base infrastructure capabilities. And now you're seeing the emergence of a next layer of application companies. And some of that is infrastructure layer. So if you think about a MongoDB or a Snowflake as infrastructure software companies on the cloud, and then application layer companies like what ServiceNow or Netflix may have been on the cloud, you're starting to see the emergence of those in AI. And those are incredibly exciting. We see applications in consumer and enterprise.
Do you think they're underappreciated by the market, which is very focused still on the semiconductor stage?
I think some of the application layers are still very, very nascent. So most of our investments in this, of our venture firm activity, 75% of our investments so far this year have been at seed stage. This is where we invest anywhere from $1 million to $3 million in a fledgling company that has 2 or 3 people and a bright idea. And that's where most of the activity is. So it's still very nascent. I don't think it would hit the public market for quite a while.